In today's environment, it's easy to think that the stock market valuation is no longer important. Consider the following. Tesla trades at a price-earnings ratio of almost 380. That compares with a P/E ratio of only 33 for the overall stock market. That valuation level makes Tesla worth more than the rest of the automotive industry combined. Newly public Rivian has almost no revenue, and yet it sports a $100 billion market capitalization, which is more than either Ford or General Motors. Bitcoin, other cryptocurrencies, and SPACs have parabolic price graphs despite the fact that there are often no true fundamentals against which their values can be measured. Despite this recent evidence, we believe valuations do still matter. Perhaps over shorter periods, which admittedly can sometimes feel not that short, valuation can be a secondary consideration. However, even financial instruments can't defy the laws of gravity forever. The cyclically adjusted price earnings, or CAPE ratio, sometimes also referred to as the SHILLER P/E ratio, is still below where it was in the 1990s, but it has eclipsed every other period since 1870, including the stock market bubble in 1929. While this doesn't necessarily imply a crisis is coming, it does mean that stock market returns will very likely be lower in the future. Low valuations today lead to high future returns, and high valuations lead to low prospective returns. The timing on that isn't an exact science, but the concept is very close to an absolute. Consider China and Japan. Since 1997, cumulative GDP growth has been almost 6 times stronger in China than Japan. However, China's stock market outperformed Japan's by only a little. And over the past 10 years, Japan's stocks have actually outperformed China's. How could sleepy little Japan have kept pace with big, dynamic China? Well, the answer lies in valuation. By most valuation metrics, stocks in China have traded at a wide premium to stocks in Japan. Japan looked more like a value stock, whereas China more closely resembled a hot technology stock. China's high valuations have so far led to lower future returns, and that could persist for some time into the future, despite its stronger economic growth rate. Similarly, given the historic valuation disparities today of growth versus value stocks, small cap versus large cap stocks, and domestic versus international stocks, it would not be surprising to see very different market dynamics in the future. Sticking with today's high flyers, SPACs, and cryptocurrencies may be akin to buying internet stocks in the 1990s, Florida real estate in 2007, tulip bulbs in the 1600s, or shares of the South Sea Company in the early 1700s. Bubbles have been a part of the investment experience for centuries, and it's likely we will look back on today's most highly valued investments as yet another example. Focus on valuation, and you'll likely be better off in the long run.